Hi, folks. Have you ever wondered if you've put your money into a fund, can and will you get your money back when you need it? We'll let you know right after this. Hello. I hope you
Hello.
had a chance to see our previous show with Tony Javier. It was really good stuff. Welcome to the Passive Wealth Ask an Ugly Question show.
Mm-hmm.
And this is one that most funds do not want to actually talk about. They dance around it, and we're not going to. By the way, I do have some breaking news. Breaking news. All right, never mind. I really didn't. I really didn't. I just wanted to see the graphics. The breaking news is that I'm in Scottsdale, Arizona, where it's 30 degrees cooler than it is in my house in Charlotte.
Yay. Yeah, it's beautiful today.
That's not very fair. I will have to say it was 87 here on Sunday. So
well,
I
you
did
did say,
enjoy it a little bit.
and your internet sucks. That's you
What,
keep
am I
kind of going
freezing?
in and out.
Yeah, you keep freezing.
Yeah.
Well, that's mostly my personality, I think.
Yeah.
It has anything to do with the internet.
That's his long pauses between the words.
Yeah. He's practicing.
Don't you call that awkward silence?
Oh,
That's
yeah.
that's exactly right. That's
You know
exactly
how much
right.
I hate the awkward silence. That's why I'm always gotten. Oh, look, Hawaii is cold today too. Thank you,
Yeah,
Scott. Private message that you guys didn't get to see.
It must
Scott
only be 70 degrees.
Our evil man behind the curtain is unfortunately stuck in Hawaii. Darn.
Poor guy.
So I really haven't gotten a chance to see any of the employment numbers this week because I've been out. Haven't seen the mortgage numbers either. I'm assuming they're about the same as they were last week. So we can just move on with that.
A lot of stuff has not changed. And we sent out a survey monkey to a lot of people on asking about, more ugly questions that we can ask out there. And we got a really great response. And I'm so grateful to all of you for putting your 2 cents in and sharing with us, what it is that that you're interested in hearing about. And I think we got 38 new questions, which I think will be great.
And we'll actually answer some of them.
Yeah.
but before we get into that, I have failed to mention that we are Carolina Capital Management. We are a lender for real estate investors in the Southeast. And if you're a borrower interested in borrowing money, go to our website, carolinahardmoney.com, click on the Apply Now button. If you're a passive investor looking for passive returns, click on the Accredited Investor tab. Don't forget to share, like, subscribe, hit the bell. We do have a comment section on the right side of the screen. And if you're on YouTube, I believe, and if you're in Facebook, it might be at the bottom. I'm not sure. But feel free to ask any questions you want while we're on the air. Did I leave anything out?
Nope, that was good.
Nope, thank you.
Covered it all.
Excellent.
Let's get to our ugly question.
So our question, and I'm going to summarize the question.
Wait a minute. We need the noise. We need the
ugly question.
Now you can talk.
I like your professional way of doing it. We need the noise. There's also visual.
I know. I've got brain fog.
Visual.
Just say what comes to my brain.
So I'm going to summarize the question, and it's basically when you invest in a fund, how soon can you expect to get your money back if you needed it? So I'm going to give that first attorney answer. How do you like that over your face there, John?
I know. It's like my own mask. It's my own mask.
My attorney answer is it depends. And it depends on a lot of factors. What kind of fund have you invested in?
Exactly. Is it a closed-end fund? Is it an open-end fund?
Yep.
Mm-hmm.
You'll find that most funds that are syndications, where the fund is really invested into one particular project, that it's going to be closed in, and you're not going to get your money back until the project has been completed. Right?
That's right.
Yeah. I mean, most of your syndications are closed-end funds where, sometimes there's a pref that's paid along the way. So you're getting some interest along the way.
A preferred rate. So
preferred rate of return, whatever that may be. And then you get a, whatever kicker or equity split at the end that you're supposed to get plus your principal back, assuming everything goes well.
And then you can have some other funds that are, let's say they're dealing in notes and mortgages. Those typically are either going to be open-ended fund. You can still have closed-ended funds where that fund is going to end at a particular period of time, but you can still move money in and out at virtually any time. And then at the end, they're just winding it down, or there's a maturity date of your funds. The fund itself may have an open-ended date, but your exposure to the fund may have a end date to it, and then you have to recycle into something else maybe.
Yeah.
But I'll give you an example of our fund. You have to stay in our fund for at least 24 months. It doesn't mean, and by the way, we're not, this is not a commercial for a sale of security. Your mileage may vary, all that kind of stuff. This is education purpose only. So in our fund, it's 24 months. You have to be in it, and you could still get your money out within the 24 months. But it's kind of like taking a CD out early, cashing in your CD early. There's an early payment penalty if you want your money out within the 24 months, and there's a percentage of the balance you take out that you're going to be charged. There are cases where, and for us, it's like 60-day written notice. And I want to be very clear. It's as soon as the manager can get you the funds. Now, one of the things that fund managers have to do is, while they're managing the fund, they have to make sure that there's enough liquidity in the fund to operate the fund, to make sure that you're taking care of all the investors. And you never want to put your fund in a position where you're giving somebody money back and you need that money to work deals that's going to make the rest of the investors a decent return. So you never want to be cash poor in a fund. You always want to have reserves and whatnot. So you have to balance that. Fortunately, with our fund, it's short-term loans. So you have to wait for new investment to come in and loans to pay off and that type of thing. And because it is a short-term investment every time, well, being in a fund is a long-term investment. The loans we do are short-term loans. So the chances are that a loan is going to be paying off fairly quickly, and the chances that somebody is going to invest new money into the fund are pretty high. So it's fairly easy to get that money back. Now, there may be times where a fund manager will freeze their redemptions for a certain period of time. I know during COVID that there was a lot of funds that not only did they freeze redemptions, but they put a freeze on people putting new money into the fund too, because they didn't want to have extra money in their fund that they couldn't invest, and then that drags the yield down for the rest of the members. And at the same time, they were holding on to capital, so they didn't want there would be a run on the bank, so to speak. And so it takes a little longer. Now, I know back in 2019, we changed the way that we lent money to others. We got out of the luxury market, and we moved into the affordable housing market, which meant our expected returns were going to be a little bit lower than we first advertised when we went into business. And as you go through real estate changes, you always have to tweak it. So when our expectations were a little bit lower, we allowed anybody that was in the fund to get their money out when they could, but you had to do it in a timely manner over a longer period of time so the rest of the investors wouldn't suffer from that. Yep. So in those cases, it may take longer to get your money out.
We'll talk a little bit about that, because I really think that's what this question was based on, and we'll get to Wendell's question here before we leave. I promise, Wendell. But I think that was really what pushed the question is
sure. So
people were saying, well, it takes longer than 6 months to get my money back. What's the point?
Yes. Okay. In that case, it was taking a little over a year to get your money back, because we had a few people that thought that they could do better, and that's fine. I get that. And that's not what we advertised at the beginning, and we expected that. That said, we're a lot quicker now. But when you have a big rush, you can't. Everybody has to get in line, and you have to send it out when you can.
Yeah, you can't have a run on the bank, because if you gave everybody back their money at the same time, you would have no money to make loans with, which would make the people who were still in the fund not be able to make any money, or their returns would go down.
Yeah, we have a fiduciary responsibility to the fund, and if you're changing and not being a part of the fund anymore, as much as we want to be your fiduciary, we have to make sure that we're first and foremost operating the fund at a profitable level. And
plus, if you're doing what you should be doing, your money is all loaned out, and if 6 months is our shortest term, so it's going to take a while to get that money back in to be able to distribute.
Mm-hmm.
And we're almost caught up with that. I would say after the probably 2 quarters from now, it should be no more than 60 to 90 days.
Which is really short.
Yes. What was Wendell's question?
Yeah, you take like a closed-end fund. I mean, let's say it's a 5-year closed-end fund on a syndication. I mean, there's only 2 ways you can get your money out. Wait till the end of the syndication, or have another investor come in and take your place.
And that's another good option. That's another good option, Jonathan.
And the thing is that you can sell your shares to somebody else. It's not, you can't publicly trade these shares, and you can only sell these shares to somebody that the manager has approved. And essentially what that means is they also have to be an accredited investor if you're going to sell those shares.
Assuming you're in an accredited fund, yeah.
Right.
Yeah.
And the manager leaves that open, because while they don't mind people trading shares, they don't want someone who's not going to be a good fit for the fund either, because not everybody is built to be in a fund.
Right.
If you're an active investor and you like playing the game, and now you want to buy somebody's shares, and you're going to be a real pain in my rear end, specifically, if you're not the passive type of investor,
you won't be happy.
No, you're not going to be happy, and you're going to make me miserable. And life's too short.
Yeah, I mean the best kind
you're going to be miserable.
Yeah, like if someone's passive and they're looking for long-term gains, the best kind of fund that they could get into is an evergreen fund or an open-ended fund, because you can compound that for as long as the fund, the fund is, going to stay open for, theoretically forever.
It's funny. I had this conversation last night at dinner with one of our collective genius friends, and she was saying she just invested in a fund with one of the members. Mm-hmm. She's feeling weird about just collecting checks that she doesn't have to work for, and I'm like,
I'm okay with that.
Yeah, I know. But when you're an entrepreneur and you're used to being in the trenches, so to speak, it's a weird feeling that you're not working for this. And I said, well, you're just going to have to get used to that.
Yeah, it's a
You need
change
to
of
think of it
mindset.
this way. It's giving you time to do something else.
Well, you've what I tell those people that I have those conversations with, like you've spent a long time working really hard for your money. Now your money gets to work for you. Like
That's right.
It's a change of a mindset. It's you're no longer working hard, your money is. And
Absolutely.
I mean, it takes hard work usually for most of us to accumulate enough money that can work for us.
Right. Yeah, that's the goal.
Mm-hmm.
Wendell's
Let's get to Wendell's question. Wendell, when the money goes into a fund, basically, when does it start earning? I know it doesn't always earn right away, and let me explain why. In most funds, and not all, but most, if they're smart, they set it up this way. They usually pay on the month or on the quarter, and if you get new money in on the quarter or sometime in the middle of a quarter, it's not really fair to the other investors for that money to start earning right away. Why? Because you're adding money that hasn't been contributing into the numbers, because the numbers are whatever the profit is minus the expenses based on the amount of money under management. That's the return that everybody gets. So you
during that period.
Yeah, and if you add new money to that period that hasn't been earning, you're diluting the returns for everybody else. So what most funds set up is a subscription account that's separate from the actual fund account, and that money will go in there. Now, it could be used, and in our case, if it's used, we pay 8% interest on it until.
And it usually is used.
Yeah, so it goes into that subscription account, but if we use it in a loan, we're going to pay 8% interest on it until the end of that quarter, and then it goes in with the 8% balance to the fund itself and starts earning whatever the fund makes. But you always have to have that little buffer there because it protects the investors that are in there from having their returns diluted. I hope that answered your question.
That was a good, solid answer. And I think one of the things
I like most of my answers.
Yeah. Yeah, this one's different.
Just to reiterate, this is all for educational purposes. These numbers are hypothetical, and your mileage may vary, right, Bill?
Yeah, disclaimer. I think what's important to know too is that funds are for the collective good. That you can't put one person over another, or one investor over another, because they might have $1 million in the fund where somebody else only has 300,000. You have to take everybody's benefit into account and do what's best for the entire group, not just one or two people or the management company. You can't make decisions based on that either. It has to be for the collective group.
How many decisions have we made for the not for the benefit of the management company? Just so we can protect the investors.
That happens daily, and it's it'll sure work your character out, won't it?
Mm-hmm.
Wendy sounds like somebody that should be running Venezuela. It's for the collective.
Yeah, that did sound a little socialist, but
that's
that wasn't the point.
It is the whole reason that you get into a fund is for the diversity and the safety, and at the same time, your money is always working. Once it's in there working, it's always working.
Right.
We love the note business, but when a note pays off, it's not making any money until you get it into a new note.
That's right.
That's one of the benefits. And at the same time, you have a chunk of change that's invested into single assets versus money being spread out over all the assets in the fund. So that said, we're going to have to wrap this one up. Hope I answered the question solidly on both. I know the last one was. And he said so. Thank you so much for joining us on the Passive Wealth Show, the Ask an Ugly Question segment. We are Carolina Capital Management. We make loans in the Southeast to real estate investors. Our website is carolinahardmoney.com. If you're a borrower, click on the Apply Now tab. If you're an investor, click on the what is it?
Investor tab.
No, accredited investor tab. Don't forget to like, share, subscribe, hit the bell. Have a wonderful week. Talk to you next time.
Have a safe
Thanks,
trip
everyone.
home, Bill.
Thank you.